Hello traders, welcome back to the Forex gig where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to be talking about the Andrew Pitchfork, a powerful yet often overlooked tool in the technical analysis. If you have ever struggled to identify key support and resistance levels, you have wanted a clear way to anticipate price movements, then this video is for you. So stick around until the end as we will not only explain what the Andrew Pitchfork is, but also show you a step-by-step strategy to use it effectively in your trading. Now we start by understanding what the Andrew Pitchfork is. The Andrew Pitchfork is a powerful technical analysis tool developed by Alan Andrews. It consists of three parallel trend lines that form a pitchfork-like shape on the price chart, helping traders identify potential support and resistance level, trend directions, and possibly reversal points. Now let's see a trading strategy that we can apply while mastering the Andrew Pitchfork. Now we understand what the Andrew Pitchfork is. Let's dive into a comprehensive strategy to use this powerful tool. The first step is to identify the trend. We identify the trend by analyzing the time frame, such as the 4-hour or 1-hour time frame, to get a clear picture of the overall trend. Then we look for a series of higher highs and higher lows in an uptrend. So when we get the overall structure of the market, we can analyze the 4-hour time frame or the daily time frame to get the overall trend. And as you can see in this part of the market is making a series of highs. This is a series of higher highs, a series of higher high, breaking the previous high, and at the same time is making a series of higher low, higher high. This is a higher high, a higher low, and it's going to make another higher high at this point. So currently we can decide and say that the market is in a bullish trend. Now that we have seen or we have stated the trend of the market, we will get a clear picture of the overall trend. We look for a series of higher highs and higher lows for an uptrend. Now as we can see from the 1-hour time frame, you can see price is making a series of highs, higher high, a higher low, a higher high, a higher low, a higher high. It broke structure to the downside but came back here, made a higher low, a shift in market structure, signifying price wants to go back to the higher time frame, go back to the uptrend, to resume its uptrend. It comes here, printed a higher high, came here, printed a higher low. So this is a crucial step as the Andrew Pitchfork works best when applied to a well-defined trend. Now once we have defined the trend of the market, we would apply this, we would plot the pitchfork indicator. Once we have identified the trend in the market, we'll apply the pitchfork indicator. We locate three significant plot points to draw the pitchfork. The point A should always be the start of the trend, and as we can see, this will be the start of my trend. Point A, the start of your trend. The point B, while the point B and point C are subsequent reactions, highs and low. So I'll click it at my point B, which is my high, then I will draw to my low, which is the retesting point. This is my point C. So you draw it from your starting point, point A, to the point B, to the point C. This is how you draw your pitchfork on your chart. You have to always make sure the median line passes through point A and the midway point between point B and point C. This is basically what it means. This midway line passes through the midpoint between point A and point B. The third step is to observe the price interaction After plotting the pitchfork, you have to observe how price interacts with these trend lines. The upper and the lower trend lines often act as dynamic support and resistance level, while the median line serves as a magnet for price action. You have to pay close attention to how price behaves when it touches this line. And as we can see, when price touch this end line, this other line, it pushed price to the upside. Price touch this line, it pushed price to the upside. As you can see, price tried as much as possible to keep on going towards the upside. Now, the next step is to plan your entry. After plotting the pitchfork, you have to observe how price interacts on the trend line. When you have observed this, you have to plan your entry by, for a long position in an uptrend, you have to look for price to touch or approach the lower trend line. You have to wait for price to approach the lower trend line, like in this case. This often represents a potential buying opportunity. When price touches the lower trend line, it creates a potential buying opportunity. This is basically what it means. Then if price touches a downtrend, if we plot this on a downtrend, let's look for a downtrend example. So in a downtrend, we consider placing short position when price touches or approaches the lower trend line. So drawing this on our down our down our downtrend area, we draw it from high to low, then project this back to the high, from point A to point B, back to point C. Then you watch how price reacts from this area in price, the higher part of the trend line, the upper trend line. This is how you watch how price reacts from that side. So if you are taking a trade, you look for your entries at this higher part of the trend line by looking for bearish confirmation. You can look for a bearish engulfing candle, or after an indecision candle you look for bearish candles, and we can see bearish engulfing followed by a bullish engulfing before two indecision candles. Then a candle that closed below the indecision candle can be your signal to enter your trade. And at this area, this is where you'll be looking to enter your trade. While for a buying opportunity, you'll be looking to buy your trade at the lower part of the trend line. This will be where you want to buy your trade. You put your stop loss just below the lower part of the trend lines. While in a sell trade, you put your stop loss just above the upper part of the trend lines. Then you set your profit targets. The logical area for profit targets, we use a conservative approach, and this is to target the midline. For an aggressive trader, you can aim for the opposite part of your trend line, but conservative area should be the midway point of the media point of your pitchfork indicator. But there is no harm in targeting your other side of the pitchfork too. When you aim for the opposite side of the trend line, this will give you a risk to reward you are looking for. Same time, in a buy trade, you just aim for the opposite side of your trend line. Remember, stop losses are crucial, and you must also place them below the lower trend line for a long position, and for a short position above the trend line. Do not forget about this. This approach actually gives the trade room to breathe while they are still protecting your capital in case the market moves against you. This is why we use a stop loss and put it in a place where there will be enough room in case the market moves against you. We can incorporate this strategy with other confirmation tools to increase the profitability of successful trade. You can use additional technical indicators for confirmation, such as your RSI indicator or your stochastic oscillator, as they can help you to identify overbought and oversold conditions at this trend line. You can also look for bullish candlestick pattern at the lower trend line for long trades, or bearish candlestick pattern at the upper part of the trend line for bearish trades. This is how we can incorporate tools to this indicator, to this technical analysis. If we add our RSI indicator to this setup, it will help us to picture an overbought or oversold condition in the market. And as we can see in this area where price decided to reverse from, price was trading below 50, meaning we are in a selling period. So this confirmation has actually confirmed the price, what price is doing in real time. So combining this with your RSI indicator can help you confirm your entries and exit points. For the buy trade, if we add our RSI indicator, this will better help us to get a good picture of what is going on in the market. And as we can see in this area, price is trading above the 50 region, signifying a trend to the upside. We can also use this indicator, we can also use this pitchfork for handling breakouts. If price breaks out of the pitchfork boundary, be prepared to adjust your strategy. A breakout below the trend line can be a sign of strong downward trend or strong bearish pressure. Once it breaks out below the trend line, is a sign of strong downtrend. And when price breaks above the trend line, this is a strong bullish momentum signal. Always consider using a trailing stop to capture potential extended moves. So when price breaks out, this can be a signal for an extended move in price. If it's from the upside, it means that price is going to the upside. Price is going for a strong bearish bullish momentum, and when price breaks out from the downside, it signals a strong bearish momentum. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, subscribe and turn on the notification bell so that you will never miss out on more trading tips and strategies. Thank you for watching, and I will see you in the next video.